I think as Asia and emerging markets have become much deeper, there's been some very interesting opportunities arisen for investment in areas such as tourism, such as retailing, and of course such as communications. We initiated a position in Auckland Airport in New Zealand, which is a big beneficiary of Chinese tourism as more and more people go on holiday there. And also a company such as Telenor in Norway, which has large stakes in Asian communications companies, gets exposure to the region but is actually domiciled in Norway. I think there's two parts to that question actually. The overall low exposure is really just a function of relative attractiveness elsewhere, because if we go back 20 years, Mint had quite a lot of UK exposure because the UK was the only place where you really got dividend yield. But over the last 20 years we've seen so much increase in yields all over the world that we've been able to diversify. In terms of the valuation, although the UK does look quite attractive on a valuation basis, there are still a lot of headwinds to overall growth, so we prefer to be in higher growth areas where there's tailwinds. It's always very, very difficult to try and forecast the direction of currencies, and since the US started tightening in 2013, the dollar had pretty much gone up in a straight line. Now they've stopped tightening, there's certainly all the fundamental reasons as to why the US dollar might begin to weaken. And if it does, then it's most certainly very positive for Asia and emerging markets. It takes the pressure off inflation because the cost of imports, particularly of food, would go down if the dollar weakened. And it would also increase flows into those regions. So we'll just have to see. I guess the biggest issue with the US election is the issue of protectionism, because the incumbent president is the person who has embarked on this really one-person crusade of protectionism over the last few years, and would like to see that issue resolved. I think if protectionism gets any worse, then it's a negative for all global markets, because growth will be lower and inflation will be higher. So hopefully that can be resolved with a positive outcome in the US election. When we look at the growth outlook for the developed world, we see much tougher future. And that really is what you might expect after 10, 11 years of a business cycle. These business cycles are pretty long in the tooth. The main fear from a stock picking point of view is that there's cyclicality in businesses that hasn't appeared at the moment, which means that as growth slows, revenues and profits will slow. That's why we tend to favour other areas of the world where growth isn't slowing, where growth is actually accelerating, because you're more likely to get higher revenues and higher profits in those areas for the companies in which you invest. I think for all Scottish people who either live or work in England, I think you have to be fearful that our oldest rival on the football field might win the European Championships. But from a financial market point of view, we would be fearful that there's some bad debt cycle coming. With slowing growth, that's when you tend to discover that certain companies or individuals can't pay their debts. And it happens time after time in a slowing growth. So that would be one area of real concern. In terms of a reason to be cheerful, then I think in the last few years we've begun to see a real disconnect and independence of emerging economies from the developed world, the so-called decoupling. That doesn't necessarily mean that markets will decouple, but once economies decouple and emerging Asia and emerging markets become less dependent on the developed world, then there's real scope there for them to get revalued and to move ahead regardless of what happens in the developed world.